Welcome to Show Me the Money with Michael Derk. Show Me the Money is a podcast that is bringing in industry leaders in the commercial real estate sector that are either on the financing side, the development side, the acquisition side, disposition, brokers, investors, bankers, management companies, everyone that's in and out of the business and all facets of the trade, so that hopefully you can benefit if you're looking to grow your business, start your business, or maybe transition into something else. On this episode of Show Me the Money with Michael Derk, we have Mr. Stephen Gordon, who is one of the titans in the finance industry, one of the biggest bankers that I know in California. Very honored to have him here as a guest, and I think you'll benefit greatly from listening to him and the expertise of what's really happening in the banking world today as far as deposits go and challenges that lenders are having, especially as interest rates are in flux and the Federal Reserve is changing things very aggressively in a very short time frame. I hope you enjoy. Thank you. Good morning, everyone. Welcome to the third episode of Show Me the Money. I'd like to introduce our first guest right here is Mr. Stephen Gordon. Stephen Gordon, thank you for being here today, first and foremost.
It's a pleasure.
Stephen is the founding chairman and chief executive officer of Genesis Bank. He has nearly 40 years of financial industry experience, including serving as founding chairman, chief executive officer, and president of Opus Bank, founding chairman and CEO of Commercial Capital Bank and its holding company, Commercial Capital Bank Corp. Incorporated, as well as chairman and CEO of Fremont Investment and Loan, which I actually formerly worked for, and its holding company, Fremont General Corporation. Additionally, Mr. Gordon served as partner at Sandler O'Neill and Partners LP, a New York-based investment banking firm, now Piper Sandler, and joined the firm at its founding in 1988. Genesis Bank is a California state firm, chartered commercial bank, organized by Stephen. The bank focuses on serving the financial needs of small to mid-sized businesses and owners and investors in income-producing multifamily and commercial real estate located primarily in the diverse majority minority markets of Los Angeles and Orange counties, California, as well as western portions of the Inland Empire, Riverside, and San Bernardino counties. Genesis Bank is designated by the FDIC as a minority depository institution, MDI, and is only the second diverse multiracial MDI in the U.S. The bank's products, services, and solutions primarily include traditional commercial business, small business administration, known as SBA, income property, and owner-occupied commercial real estate, loan and deposit products, as well as treasury management services and solutions. Genesis Bank is headquartered in Orange County, California. So, starting right in here, Stephen, what has the last year looked like for you and Genesis Bank as far as deal volume and the transition of the interest rate market? How are you, how have you seen things over the past year?
Okay, so Mike, first, thanks for having me. All right, second, listening to my bio, all that really means is I'm old, and I've been doing this for a long time.
It's impressive.
It's not really all that impressive. But the last year has really been a whirlwind. We launched the bank August 2nd after Opus was acquired in 2020, and really felt there was a need for a bank that could have true impact in the communities that we serve, and have that both be economic impact as well as social impact. Sure. And felt like in listening to the bio, when I said all it means is I'm old, it's at now 60 years old. I really felt that while there were a lot of other ways of measuring the impact that previous banks that I built had in the communities, that here, that this bank from almost, I've been asked if this is like a legacy kind of thing, but this bank must be the most impactful bank that I've ever built. Okay. So this last year has been the whirlwind of launching the institution really a year and a half ago in August of 21, and then forging partnerships with the Hispanic Chamber, the Black Chamber, the Asian Business Association, being extraordinarily responsive to the clients that we previously had, let's say back at Opus or back at Commercial Capital Bank, and that following that we've built, as well as making sure that we're doing all that boring stuff like making loans and bringing in deposits and growing the balance sheet of the bank, and making sure that we're really understanding internally the role and purpose and mission of the organization of the bank, and making sure that everybody buys off on that mission, and that we're really on offense while we're surrounded by banks now that are playing defense.
Yes.
And that happened very quickly in the midst of everything, while the Fed has been very constructive dealing with inflation and whatever those actions may now bring.
Right.
And I think we launched the bank knowing that at some point there'd be an economic cycle that would hit, and that banks have a tendency to back away and clean up their own mess whenever we hit this economic cycle, and it's happening, but it's been a real slog battling in the trenches every day, and building the company.
Right. Well, it's hard enough in the best of times starting a company and growing it, right? As maybe you started the company 4 or 5 years ago, it probably would have been a little easier. Obviously, you come out of the gates right now and you're just like, boom, with obviously everything transitioning, tightening of the balance sheet, interest rates doubling, the market slowing down, all those variables. Obviously your experience goes without saying. You're the right person for this, to put this together. And I think you're really going to be seeing the examples magnified exponentially from a lot of your competitors out there of decisions they've made over the last 3 to 4 years. I mean, you know them as well as I do. I don't even need to say names, but a lot of these lenders we've worked with on the multifamily and commercial sector over the last couple of years can't even sell their paper now because the rates are too low. So they're having deposit issues, big deposit issues, because deposits are going to non-money center banks at much higher returns. So they're really at a standstill in some cases, and it's becoming an issue to do deals with them on this side, and it's affecting the ability to transact in the market. So I don't know if you want to maybe speak to that and how we kind of.
Well, you've made like 5 or 6 really important points somewhere, inside of all that, which is, the last 5 years, and you've heard me say before, we're 12 years into a 10-year cycle.
Right.
And during the last 10 years, all you had to do was own something. You didn't have to be all that bright. You didn't have to be. You just everything was going in one direction, and it was very clear it was going in one direction. And now you really find out how good you are. Now you got to be, you got to be really skilled. You got to be really talented. You have to have seen cycles before. You have to know how to navigate a cycle, an adverse cycle, and you have to understand that things don't only go in one direction.
Right.
And you're bringing up a very interesting point about deposits finding their way into somewhere else.
Right.
They're not even moving into money center banks. They're moving, in a sense, almost out of the banking system. And all of a sudden, banks are competing against the Fed, and banks are competing against the U.S. Treasury, and they're competing against the capital markets.
Right.
And when I say that, it's that short-term treasuries are now 4.5%. And no bank wants to pay 4.5% for deposits. Right. And depositors are suddenly paying attention to the interest that they earn on their money. And for years, for a decade, nobody even cared because they were earning almost zero on their money anyway.
Right.
So they didn't look at what the interest was that they didn't earn. And now that money, everybody is scrambling, really fighting for liquidity, fighting for deposits, and making sure that at least here at Genesis, we do everything we can to differentiate ourselves so it's not just about rate.
Yes.
Like you got to bring brain power, you got to lead with brain power, you got to lead with ideas, you got to lead with solutions, you have to lead with something besides just I can offer a better rate on the loan or a better rate on the deposit, because I think anybody
certainty
can
of execution.
do that.
I mean, is huge.
Certainty of execution is important in a market where the other point you brought up was all of a sudden there are fewer lenders.
Right.
And we've seen that happen before.
Right.
In past cycles. It's gone from those who were dominant multifamily commercial real estate lenders all of a sudden laying people off, shutting down divisions, moving liquidity and capital, allocating it elsewhere in their organizations. And this is even without the credit part of the cycle hitting yet. Right now, the only component of the cycle that's hit is structural liquidity related components of the cycle.
Yes.
But if you look at all the bank's earnings that are coming out, this quarter, we're still not seeing a credit problem.
Right.
It's not as though non-performing assets are increasing on balance sheets,
Right.
but reserves are increasing in anticipation of something that may happen at some point.
Right.
So it's everyone's looking for when the real crisis is going to show.
Sure.
But right now, the crisis is that of how are you going to fund that next loan that you want to make?
Right.
What are you going to fund it with? Because if you plan on funding it with deposits, they're going to cost you maybe 3 times what they would have cost you before. And if you're not going to fund it with deposits, wholesale funding, capital market type of funding is extraordinarily expensive. That's all costing north of 4. So it's, the regulator's greatest concern right now isn't loan portfolios that are going to blow up. It's liquidity in the banking system, because liquidity is leaving. But that's exactly what the Fed has been trying to do, to slow down the economy, get banks to stop lending. And the way to do that is dry up liquidity.
Right. So the result is here of what they've set out to do. So the question is, where does it go from here? I mean,
It only gets better.
I mean, it's it's pretty daunting and scary, but there obviously is a light at the end of the tunnel, and there is going to be great opportunities. And I have so many clients that are, say, hey, Michael, where are these notes? You have all these lender relationships, and they've got to be so underwater. And the basis is across the United States today, there really isn't those opportunities. I think I've gotten 2 phone calls in the last 12 months on 2 notes out of 500 different lenders we work with.
Because banks don't have to mark the loan portfolio to market, right? That all just sits there in what's kind of like held to maturity.
Right.
And those loans were made at par, they stay on the books at par, and that may be a loan that they made at 3% that's fixed for the next 7 years.
Right.
And maybe the borrower is paying interest only.
Sure.
It's not amortizing, and the loan just sits there. But their next incremental cost of funding is north of 3%. So they're underwater, absolutely.
Right.
But they're not forced into selling.
Yes.
They're not going to be forced into selling until liquidity really becomes a problem beyond where it is today, or where non-performing assets begin to become a real issue. You had mentioned that you were also at Fremont General. I was brought into Fremont General to clean the place up.
Right. Fremont Investment Alone. That's where I started as an analyst. Yeah.
That place was an absolute disaster. And it started out with liquidity, and then it turned into non-performing assets, and then it turned into, they originated a ton of subprime loans.
Oh, yeah. Well, they were one of the largest subprime.
120 billion of subprime loans that they originated.
And the regulators made them make those loans.
And when all that stuff begins to crack,
Right.
that's when things start coming out for sale.
Right.
And we're not quite at that point yet. And are we going to get to that point is really driven by what the next Fed moves are.
Right.
And if the Fed does what the Fed is expected to do, which is, in the next handful of days, 25 basis points,
right.
rather than the back-to-back-to-back-to-back 75s, that maybe if they really do truly do 25
right.
and pause and kind of wait to see the impact of all of this, because it is having an impact,
right.
then maybe a soft landing is possible.
Sure.
Right? Maybe.
Softer.
Or maybe the damage has already been done. Right?
It's pretty significant. I mean, obviously on deals we're underwriting right now, the cap rates versus interest rates, it's completely out of whack.
Right.
Like you were talking about, we have the inversion on the yield curve right now with short-term money, 5 and 7 year T-bills north of the 10-year treasuries.
Yep.
SOFR is very, very high right now. So you look at these spreads and, I mean, it's difficult. The rate caps on some of these larger deals on a bridge facility and whatnot through agency execution, it's several $1 million potentially up to that basis to get some of these rate caps and some of these deals we're working on right now. So the economics on deals are very challenging, to put it very politically correct.
Well, add on to that somebody wants to pay off a loan, they're having to come to the table with more equity than they thought they were going to have
right.
to. Right? They're coming to the table with money that only 6 months ago they weren't having to.
Right.
And that's because of how fast this all moved.
Yes.
And it's also because of how we banks are having to underwrite loans.
Right.
Right. And then the idea of, but still people are paying relatively full prices for assets when they're buying stuff.
Right.
So there's a bit of a disconnect there.
Yes.
Right.
Well, there's still exchange money in the market today as
That
we speak
needs
that
the
needs a
other
place.
side.
As soon as that, we've seen the volume significantly across the country go down. As soon as that exchange money leaves the market, dries up, now we have fresh equity coming in to buy property. Now that's where the rubber hits the road, and that's where we're going to see real pricing
Well,
change.
ironically, when you talk about the exchange money, you think of that as the exchange money that's happening outside of the banking system. That's somebody buying an asset and wanting to, or selling an asset and wanting to defer their taxes,
yes.
their tax basis into what they're buying. Right, but that's happening. It's touching the banking system because a lot of banks out there actually end up escrowing or handling that 1031 exchange transaction
Being
on
an
their balance
accommodator,
sheet,
which you do, right?
Which I did back at Opus. I had acquired Commerce Escrow
Oh, yes, that's
and
right.
RPM Investments,
Right.
and they were the largest independent 1031 exchange accommodator in Southern California.
Right.
Well, now Pacific Premier, who bought Opus, in their most recent earnings release a couple of days ago, they actually stated that those balances have significantly declined.
Oh, yeah.
That they were holding. And at one point, I think I had about 700 million of it, and those balances, I'm sure, are a fraction of what they were. Whereas we organically started that over at Genesis, and we're growing it.
Right.
We're taking market share away from others who are really struggling.
Yes.
But that you can generally measure how the business is doing by looking at how those real estate deposits are doing.
Right.
And they're down significantly across
yes,
the country.
100%.
So volume activity. And then we've got a tax lawyer who's on our board, a well-known tax lawyer, and his business is now real estate tax lawyer. And he's doing about 20% of the business he was doing 6-9 months ago.
Right.
So we're seeing a real shift occurring.
Significant. I mean, it's going to be affecting everyone across the board. There's no one going to be left unscathed. And, a guest we had earlier on the show, in talking about this, it's affecting the tenants in the real estate. It's affecting the owners of real estate. It's affecting the banks. It's affecting the owners of banks. I mean, it's affecting everyone who's relatively, you look at the ripple effect in real estate and banking, you drop that pebble in the middle of the pond and that whole pond ripples, right? So that's the effects we're seeing here. Just the cost of living has gone really through the roof in the last couple of years. But
in a way, the contrast side of that is this is great opportunity.
Yes.
Right? We've gone from that environment where there were 20 bidders on a property, and every bank was clamoring to make the loan.
Right.
To all of a sudden, maybe there's an opportunity. I don't mean to use the word redundantly, but an opportunity for us to be opportunistic.
Yes.
And go on offense when everybody else is on defense.
Right.
And I think there's been a lot of money on the sidelines waiting for this moment.
Yes.
Waiting for the moment to be able to, when things start to crack and break,
right.
Maybe there's an opportunity to buy something a little cheaper. Maybe there's an opportunity to aggregate. Maybe there's needs for a different kind of financing, like acquisition lines.
Right.
So that when the opportunity comes up, you can seize that moment and take something down and then put permanent financing on it afterward.
Right.
There's so at the bank, I'm looking at it that way.
Which is great.
All of a sudden I've got banks around us who are, they're laying people off, shutting down divisions, and dislocation is occurring. And that means we can go on offense.
Which is excellent. And that's very rare in the banking industry because most banks are clamoring today, going into the defense mode like you're talking about, saying, well, if it's a 40% LTV, we'll take a look at it. Maybe it's a 6% rate. And I'm like, well, wait a second, this doesn't make any sense. That deal we just did with you 3 or 4 months ago was exponentially different.
Right.
Treasuries haven't moved that much, and all of a sudden they're saying, well, my deposits are moving out. So
that's what's driving it.
Yes, the deposits moving out of these big money center banks are really a challenge.
And also banks that were just a few months ago doing things very transactionally, they really wanted to make the loan.
Yes.
And if they got the deposits, fine. Now they're leading with how much am I going to get in deposits?
Right.
All of a sudden that's becoming the first thing out of their mouths.
Oh, yeah.
But from your standpoint, I'm sure you've got clients who who have also been waiting for this moment, who have been on the sidelines saying, I can't buy anything in the last 6 months.
Yeah.
And now they're anxiously waiting for like, what are they going to do? And there's strategies being built around this.
Right.
And I think a number of us are working on raising pools of money and making sure that we have things lined up for 6 months from now, a year from now, however this is going to play out.
Oh yeah, 100%. And in reality, I think we will see this as a huge opportunity. And a client who was on the show, earlier, one of my largest clients, he's got the ability with a checkbook in order to write checks for these deals. So when someone has to meet the market and sell, even if financing isn't there at a competitive rate today, whether it be Genesis or another bank or whatnot, he has the ability to stroke a check and do that. So people with real cash on the sidelines today can come in and pounce on these deals. Rates may fall in the next couple of years. No one has any idea what's going to happen, but that could happen. Rates come back down. Boom, you bought it right now in somewhat of a distressed time when money isn't there, readily available in a quick liquid format.
Now compare that to what's been going on for the last 12 years.
Yeah.
The contra to that is the syndicator.
Right.
And I'm getting phone calls that I never got before from people who were buying lots of assets, but they always came to the table with 20% of the equity.
Sure.
And then they always raised the rest of the equity to do their deals. Now, all of a sudden, the guy who they used to go to who put up $1 million, that guy is maybe good for 250. And the guy who put up 500, maybe they're 100, and everybody else, they're out.
Right.
So all of a sudden, we're getting asked for equity, and we don't really do that. But I'm getting really tempted to go raise a lot of equity in a fund to be able to be there for that.
Oh yeah.
But you're right. Cash is king, and the guy who's got the equity, that's really going to be the guy who's going to control, the opportunities in this next wave that we have in front of us.
Oh, 100%. Equity is becoming a big challenge to raise on deals. Even if people do have it, people are concerned because they're seeing the stock market, they're seeing the bond market. I mean, I don't know about you, but for me, I think the only thing I made money on last year was in the energy sector, which I just got lucky. But in all my financing background and degrees I have, everyone's like, stay diversified. So it's only a small sector. The rest of it, you get your head kicked in. So real estate's been great, but now that's struggling. So it's like, where is the flight to safety and the opportunity? But raising equity while people are getting out and people push the envelope, and syndicators using other people's money obviously take significantly more risk when then it's your own checkbook.
Right.
And so on that basis, I think raising an equity fund and doing that, which I'm sure is happening across the board right now with some other people, not everybody, but in order to put that together to become and capitalize on these opportunities that will be here in the next 12 to 24 months, will be very lucrative.
Yeah, you got to do it or else you're not going to be participating in what the next 12 months brings.
Right, exactly. And it's usually the most successful people I've seen in the business are the people that are, as the house is on fire and the smoke is billowing, those are the people running in, versus, when it's all rosy and cheery, those are the people who have, run to the table over the last 5-6 years and have looked like a hero, but some of them will need to leave.
Right.
And running into the building, that's burning is...
Right, and this could be different this time. 08, 09 lasted for like a blink.
Right.
And there was so much private equity that came into the system, and things that were 50 cents on the dollar all of a sudden were 75 cents, a moment later, and then all of a sudden it was par.
Yes.
Right, and then people were bidding up premiums. So that window shut really, really fast.
Right.
This is, but it was very housing focused.
Right.
It was the very subprime housing centric. This is, as you said before, it's rippling across the economy. Mm-hmm. And so how that plays into real estate, I think, is a little different this time than last time. But I think that, that the banking system isn't going to be addressed through private equity like it was last time.
Correct.
I think the regulators have learned too much from the last time around that they don't want private equity coming in and owning banks.
Right.
That doesn't really play very well. So it's, I think that maybe you and I work on that, putting together that private equity fund,
I'm
that
all
equity
in.
vehicle, and we figure out how to address all this. Because it's going to be very interesting. If people are already calling now this early, we haven't even hit the storm yet.
Right.
Right. And then will the Fed be able to navigate it? We'll see. I think we'll know over the course of the next, month or so.
Right. I mean, I look at, you made a great point, that subprime was a blink, relatively speaking, to the whole market just crashing. All government driven, right? Obviously, the rating agencies and everyone that put the A rating on, zero rated bonds, which is still mind boggling.
But everybody was culpable in that.
Yeah.
Everybody
you're
played
totally
a role.
right.
Whether it was the broker, whether it was the plumber who owned 5 homes,
Yes.
everybody played a role in the whole thing.
You're totally right. But it was like a lightning bolt overnight. Boom.
Done.
They came in, TARP, bailed did the bailout. And it's like, what just happened? Now it's almost like watching like a slow train crash where you have to watch it. They put your head in the seat and you have to watch this train crashing. You know it's crashing, but there's nothing you can really do about it. But again, the opportunities that will be there, just like you spoke about, I think should give people, keep their guts in check, I guess.
Yeah, and historically, and this is the part that's really been frustrating to me over decades here. I'm originally a New Yorker, but I've lived here since '95. Okay. And what I've noticed is that every time there's a real estate cycle here in Southern California, which is, we care a lot about here in Southern California, since Southern California economy seems to be so real estate centric, every time there's a cycle that hits, it actually takes down small business with it.
Yes.
And that's unfortunate. So, we're already seeing impact, to small business, and we're already seeing layoffs out there in the economy, and we're already seeing like all different sizes of businesses in all different sectors having to address their expense base, overhead base in order to fortify themselves heading into whatever this recession will bear. But that was part of the impetus to launching Genesis when we launched it.
Right.
It always seems like small businesses are left behind, family-owned businesses are left further behind, and minority-owned businesses are left like way in the shadows.
Sure.
And we got to find a way, all of us. Really, we've been all fortunate. Now we got to give back and be committed to making a difference in our communities here in Southern California.
Oh yeah, and I love the family-owned business. I love the stories. So many of my clients over the years are family-owned instead of the big, corporate structures. Which nothing against the big corporations, great for them, but in the same respect, I mean that's really what the country was built on, and to keep that basis there and everyone that's come over here worked hard, done the right things, and not being able to survive is really hard to watch.
And a lot of your clients probably didn't start out purely just real estate.
Correct.
They probably start out, by building a business.
Yes. Built
that business as a first, second, maybe third generation business, maybe sold the business, and then they got involved in real estate.
Exactly.
And,
well, yes, yeah.
So it's, there's the whole business part of this is critically important.
It is. It all ties together. And that's what I was saying, that everyone's going to be affected here. So, I mean, where do you see, Genesis now for this year and like next year? I mean, are you going to be, staying in the market thick and thin here? Is that the goal here, or is there a potential where you may have to or want to just step back if things do transition more, or you have more of a positive outlook from that sector?
So I like where rates are. It was tough to make money when we were all making loans at 3%.
Right.
That was really tough. But everybody was doing billions and tens of billions, and destroying their balance sheets, not realizing they were at the bank level. Making loans now at 5-6%, and funding on average at 1 to 2%. And being able to leverage 11 times in the banking system, that math works. Being a new bank with a new balance sheet, a clean balance sheet, without legacy loans, legacy systems, legacy technology, without having legacy branches. At Opus, I had 50 branches and 800 people. I don't know what I would do with 50 branches today because no one walks into a branch during COVID or post-COVID.
Right.
So not having any of that puts me in a position of really being able to be, as I said, opportunistically on offense.
Right.
And as this plays out, however it plays out, we want to be active. We want to be very committed to being there. While banks are backing away, that creates opportunity for us to opportunistically take market share. And the intention is to grow the institution.
Yes.
And it may even be that we get the opportunity to buy another few banks in this this mess as it plays through. Yeah, so I'm cautiously optimistic, and I see where the opportunities are.
Right.
And there were some of our brethren. Some of our brethren who we're all aware of in the banking system, those maybe larger community banks, they're all struggling. And I'm not so sure they really want to go through a whole nother cycle again.
Right.
Like, it doesn't seem like it was all that long ago that 08, 09 occurred, and banks battled their way through that. And now here we go again.
Right.
It just has a different flavor, but it's not fun.
No. Well, maybe I'm wrong. I mean, you correct me, but I don't think the Fed would allow that. I think what they would do is do maybe a potential another TARP for other banks that, are struggling or have those issues. So, and actually would help them put a bigger stay on them to alleviate those private equities coming in.
Right.
I think that could be a long-term play from the federal aspect.
It could. It all depends on which administration we're under. This one seems to just be giving money away, for everything, and and seems to think that the solution for everything is just throw money at it.
Right.
And don't go to the core root of the problem. I think the banking system is the healthiest it's been. It's a lot healthier than it was going into 08, 09. Capital is much higher. Credit quality is much better. And I think that the system is in a stronger position to weather the storm.
Sure.
But loan portfolios are upside down, liquidity is challenging, and securities investment portfolios are all a disaster at banks across the country.
Right.
So I think there will be opportunity. The cracks are already showing.
Yes.
And I haven't met a banker who's really all that happy. I'm beginning to think I may be the only happy one, which scares the hell out of me. And so I'm a paranoid New Yorker, right?
Right. I am too.
If I'm smiling, something's wrong.
Right.
Right. So
exactly.
But I think that's going to create opportunity, and the Fed will, the government regulators will be there to, possibly backstop the system.
Sure.
And hopefully it won't be too deep of a wreck.
Right.
Because you can't have, the crisis of confidence in the system. I don't know that everybody's ready for that again.
Right. It's a good question, and that's, time will tell. But opportunities will be there, but it's a really interesting time right now. Maybe one thing kind of addressing just you personally, maybe if you can address something, a highlight in your career that was, the high of the high, and maybe something in your career that you look back and say, well, maybe I wish I would have done a little differently, so that, the viewers here of the podcast, I'd love them to hear it firsthand from someone so successful as yourself. People talk about the good things on the resume, but sometimes, it's nice to...
No, I've got them both.
Okay.
For a while I didn't, but it's good to...
Right.
Now I look at it and you learn from both. The highs, both Commercial Capital Bank Corp. I took that public through an IPO in, I think it was 2002. And we went out with a $125 million market cap in that IPO. And 4 years later, in 2006, the bank was acquired for roughly $1 billion in an all-cash transaction. So that was a pretty good high.
Yeah,
then,
I'd say.
Then Opus was also acquired. We started that. I launched that in September 30 of 10. Just an idea on a piece of paper, and that was announced to be acquired January of 2020 for roughly $1 billion again in an all-stock transaction. And that closed in June of 10. So if you were to measure based on, economic outcome, those were two pretty solid stories.
Yeah, it's phenomenal.
But Opus was also... There's also another side to that story, which was the biggest mistake I made in my career was also made on the very first day of launching Opus, which was, I launched Opus by leading an investor group of myself and some private equity firms that are world-class, private equity firms.
Okay.
And we raised roughly almost $500 million of capital between all of us to launch the bank. That was a pretty exciting story and got a lot of coverage, and
sure.
That was pretty cool. Except for that, at the same time as launching it, I also agreed that just when someone raised their hand and said, "I'll put up $100 million, but I need a board seat," they got a board seat.
Got it.
So I had private equity in the boardroom.
All right.
And maybe I was young and naive and thought I could manage anything. And
it's also hard to say when someone's putting up $100 million to say no.
It was hard to say no, but I'll get to that in a sec. But 3 out of 9 members of the boardroom were private equity.
Okay.
And I thought, all right, 3 out of 9, I can manage that. It's a minority aspect.
Yeah.
But it could have been 1 out of 9.
Okay.
And it was an absolute misery.
Okay.
And it really kind of set the tone of the company going forward. And so I committed after the sale of the company and before I launched Genesis that if I was ever going to do this again, I would never, ever have private equity in the boardroom ever again.
Okay.
And that was my number one my number one condition.
Okay.
That was also the number 2 and the number 3 condition: no private equity ever in the boardroom.
Got it.
And I've stuck to that
because they want to be the controlling factor.
Well, that and short-term outcome versus long-term build, and everything is purely economic driven. And I'm a capitalist, so I believe in economic return also, very much so. But sometimes decisions are not all near-term decisions.
Right.
And sometimes a private equity fund's agenda may not be consistent with the company's agenda.
Yes.
And you may get to the same outcome.
Right.
But now you got conflict in the boardroom, and that sets the tone from the top of the entire company.
Right.
So, so now, Genesis is the complete antithesis of that. We're still, economic, socioeconomic, both driven and return driven, but there's one agenda.
Yeah.
And there's no conflict in the boardroom as to what the agenda is, and it's all understood.
That's great.
And I view it this way, there's 4,900 banks in the country. If someone doesn't believe in our purpose, our mission, and the impact we're having and how we're going about doing it, invest in one of the other 4,900 banks.
Yeah.
Right. And so it's, but that was my biggest mistake, I think, that I made in my career.
Okay.
And I'm committed to never, ever, ever doing that again.
Well, obviously you've been very successful, and my hat's off to you for sure. It's been a pleasure working with you and your team too.
Thank you.
They are true professionals all the way through. All the banks that you've been, the founder and CEO of, we've done business with them. And so it's been an absolute pleasure, and it's been an honor to have you here on the show.
Well, thank you.
So,
the team feels the same way about you. The team feels the same way about your whole company, and it's been absolutely my pleasure to be on the show. And I enjoyed very much having you on a panel that I moderated, and now you're moderating me, and I'm really enjoying this. So I'd love to do it again anytime you want.
Oh yeah, for sure. We'll definitely have you back on here for sure. I'm sure there's a lot more to be happening in the market here, so it'll happen before you know it. And so I think that's going to be a wrap for Show Me the Money. So I want to thank everyone for viewing the show. Stephen Gordon, Genesis Bank, founder, CEO. Definitely do some business with them because it's been a real pleasure. Thank you, everyone. Have a great day.
Thank you.